with good governance, even it's within smaller companies, breeds a lot of good questions and a lot of good thinking around how do we evolve these businesses, how do we make them more sustainable, how do we work with the community, how do we get this developed.
The whole point of being ESG is that you become sustainable and actually change the ways that you're doing things that will improve the climate, all those sorts of good things.
If you are not considering the social impacts, then you're frankly not, addressing all of the issues you should be, and certainly should have been throughout the history of resources investing, let alone, with ESG as a much more front of mind consideration today.
I'd like to welcome everyone to another Assay Live webinar, focusing on how does mining get on the radar of ESG investors. So joining us today, we have Nicholas Boyd Matthews, Chairman, Executive Director, and Chief Investment Officer at Eden Partners. We have Andrew Spark, Executive Chairman at QMines Limited, and Todd Warren, Partner and Head of Research at Tribeca Investment Partners. So thank you everyone for joining us today.
Pleasure to be here.
And I just like to thank you. And just to make a note for our audience that we will be accepting questions throughout the webinar. So please, if you do have questions for our panelists, please feel free to type them into the Q&A box. Try not to use the chat box. It's better to use the Q&A box. Just easier for us to keep track of any questions that come in. So to kick things off, the mining industry is set to play a critical role in our global sustainable future. However, the contribution of mining to decarbonization is still generally misunderstood by the greater public. And forecasts note that a significant amount of metals, such as copper, nickel, lithium, among others, needs to grow in order to enable the zero carbon future. And for the mining industry to meet this growth in demand, investment needs to grow as well. So, first question to my panelists are, what are some of the ESG strategies that are currently being adopted by the mining industry? Maybe Andrew, you can kick us off there.
Yeah, sure. Yeah, look, happy to take the lead. So I'll just talk about what we're doing. We're a quick sort of overview. QMines is a Queensland-based copper and gold explorer that's moving towards development. And we've got our flagship project is our Mount Chalmers project, which is just out of the town of Rockhampton in Queensland. And on site, since we acquired it about 18 months ago, we've actually been slowly progressing a number of initiatives to try and I suppose develop our operation in a sustainable way. So some of those include, we're actually installing our third solar system on site, which is so we're using completely renewable energy on site to house our staff and contractors and things and power all our operations. And we've just actually entered into a renewable fuels agreement. We identified quite early on that our biggest source of carbon emissions was actually from diesel use for drilling. So we've now entered into a renewable fuels agreement, which is initially going to offset our diesel use by about 20%, but we'll look to transition that to 50 and hopefully ultimately 100% as time goes on. And we're doing a lot of simple things like just procuring goods and services locally, so we don't have this big fly in fly out workforce. So there's lots of really simple initiatives out there and lots of great technologies that that companies can adopt. To improve their ESG sort of practices. And it's obviously, and we'll talk about it, I'm sure, as the panel goes on, but it's not all about, the E being environment. Obviously there's, governance is a really important thing, and also the social side of things. So, we've been, working on, we've got I think 66% of our board is independent now. We've got female representation from the top to the bottom of our organisation. And we're doing a lot of little things like sponsoring local soccer teams in the region and whatnot, and working with the community on how we sort of develop this collectively and together, and how we all benefit from it. So there's I think one of the conversation topics that will come out today is that there are a lot of simple things that actually don't cost a lot of money to implement, that companies right at the small end, right to the top end, can start to implement to improve their ESG practices.
I think on that, Andrew, not all companies are doing that, are they, though, in your sort of space? I mean, that's fairly unique, isn't it, for a sort of company? You know, I mean, as a fund manager, I find that most of the sort of junior end of the market, the exploration through to development, are not actually adopting an ESG pathway at the moment. I mean, we've probably got 40 odd companies in our portfolio, of which about 10 of those have actually taken on a roadmap to embrace ESG. And you're very much correct. The environment side is understood quite a lot over here and has been in practice for some time. But the S and the G is very much not understood. And it's all about policies and governance and obviously implementing them, you know, which is hard to persuade companies at that end of the market to adopt that. So I think you're probably a little bit further ahead. So sorry, Todd, you were about to say something.
No, Nick, I mean, you hit the nail on the head. And I was actually going to just elaborate on that very same point. And it is a source of frustration to some degree. And it happens at the big end of town as well, where there's very much a focus on the big E and it's sort of small s, small g. And I think what we saw with Rio Tinto is actually a case in point where, you know, their Duke and Gorge issues, obviously very high profile issues, were actually only seen as a big issue seemingly here in Australia. They were certainly seen as they were picked up to a larger degree here in Australia than overseas. And I think some of that was because it was not a big E issue. Now, it ultimately became a big issue, but it was obviously a big S issue and subsequently a big G issue. But because it wasn't big E, it wasn't picked up on to the same degree, I don't think, overseas, where particularly some markets like the European marketplace tend to be very much, they're leaders, to be fair, in the environmental considerations, but I think to some degree at a cost to the focus that should be equally placed on S and G.
Yeah, I think
Todd, we're a European fund that is UCITS, so we're Dublin based, which is obviously ESG has come up from Europe, SFDR, you know, and it's heading this way slowly. How does that sort of affect you as sort of Tribeca being based in Australia and Sydney? Are you sort of fully embraced into ESG or as a fund?
As a fund, yes, we are, but I think it tends to be, you know, fund by fund or indeed house by house. We run a specialist resources fund, so I think, you know, theoretically, you know, despite, you know, the ESG that's become very much a far more front of mind consideration today, I think for a long period of time, you know, as a resources investor, you've been frankly defunct in your investment capabilities and requirements to consider, for example, the community impacts, the social impacts of your operations. That as an investor in a company developing in what often, I mean, obviously not the QMines example, Andrew, but in many cases we're investing in mines that are in developing countries or you know, areas which have not had a lot of wealth invested in them for a long period of time. So any mine is very impactful, and if you are not considering the social impacts, then you're frankly not, you know, addressing all of the issues you should be, and certainly should have been throughout the history of resources investing, let alone, you know, with ESG as a much more front of mind consideration today.
Yeah, that's right. And Nick, I might just touch on something you were mentioning. It does seem to be a top-down approach. We're seeing a lot of the bigger mining companies, obviously with bigger balance sheets and more, you know, more capital to sort of transition their businesses, I think, taking the lead. And I think what we've been trying to do is show that we can actually do it at the smaller end, you know, and it doesn't actually cost that much. It just takes a real commitment. And obviously we've got a slightly different situation where we've got quite a young team, a young board, and we certainly think differently. But as I sort of outlined, and we can go through some of the different technologies in a bit more detail, but a lot of these just, you know, they're not as cost prohibitive as a lot of people think, and they don't take as much effort as you know. So you know, I think what we're trying to do is really lead that smaller to mid-sized business and say, look, we're a small cap company. You know, you can actually you know, execute these sort of strategies and reduce your carbon footprint, and also, you know, have good relationships with the community and you know, and strong governance practices, even as a small cap company. So what are you guys seeing out there? It certainly seems to be led by the larger companies?
Well, but from the funds management perspective, and I can only speak really of European funds because we're a UCITS, which is a EU regulated fund. ESG has seen investment of 30 odd trillion increase to 53 trillion into ESG funds. So ESG funds, if I just sort of explain what an ESG fund is from a European perspective, under UCITS, you have Article 8 and Article 9 under SFDR, which is light green and dark green. I like to call it vegetarian and vegan. And we're an Article 8 light green fund, which is a natural resources fund. And what we tend to do is we influence. We're an active fund manager. So we're there to invest in projects. Typically, we'll have 70% of the investment will be in beta, which will be producing assets. And then we'll have up to 30%, what we call special situations, which is in the sort of exploration through to development and then hopefully onto production. That's the area where we struggle with the ESG element. But I mean, 12 months ago, when I had meetings with companies to talk about what was their ESG, what were they doing about sustainability, it was blank faces. Now it's a hot topic and everybody's talking about it and everybody wants to implement it. I think we're going to find that ESG, whilst that is it's something that's a differential for funds, ESG funds, and that's where the money's going. I think eventually that it will just become the norm, as that's adopted into a normal governance policy of a company. So we're seeing huge inflows of assets towards money inflows into ESG funds, which is good. My biggest challenge is actually getting companies to address and adopt an ESG sustainability pathway. Now, what we tend to do is we outsource to CSA Global and ERM, and we've got a team that will do all the technicals and also put a roadmap. So they give them a pathway to adopt the ESG. And that typically is taking public information, putting that together, and then giving them a score. And the biggest challenge, I think, is with these scores at the moment, is there's so many ratings agencies coming up with different scores and methodologies of how they get there that it's challenging to determine who do you go with. So I think long term we're going to find there'll be a convergence and there'll be a standardization of those agencies as we get one sort of rating, if you like, fits all. But that's probably 2 or 3 years away. So it is challenging. But I'm pleased to say that most of the companies that I speak to now are adopting a pathway, a roadmap to become sustainable. And when you first speak to a company, their first initial response is, we're not actually doing anything that's sustainable at the moment. And you have to say to them, look, that's the point. You are going to fail. The whole point of being ESG is that you become sustainable and actually change the ways that you're doing things that will improve for climate, all those sorts of good things. So I mean, that's one thing that we have to get over. But it's certainly interesting times from a fund manager perspective, because normally it's just you look at a project and you're looking at what returns you can get from it. Now you're looking at, is there a pathway? Is there a roadmap? Is this company, as a management, actually adopting governance that will be sustainable? So it's interesting times. Are you finding that, Todd?
Yes, is the short answer. I think, well, there's a couple of angles here, right? There's companies recognizing that they need to embrace a more active management of their ESG considerations because their cost of capital is reliant upon that. And whether that's through their carbon footprint or otherwise, I think that's the reality of the situation, and companies recognizing that they otherwise, not going to be able to raise money, equity or debt. From the investor perspective, I think the ESG discussion is becoming more nuanced, thankfully. And to your very well made point, Nick, I think we looked at this just recently, and you can look at the wide variance in the ratings applied by third-party rating agencies of the ESG factors that each of these companies have to tick, and it shows you that the quality or otherwise of third-party ESG analysis is disparate. to put it kindly. And yet, I mean, Barrick Gold was one analysis piece that we saw. And if you look at all the various third-party pieces of research, there was like a 50% variance in a score applied. So if you were a pure quant ESG manager, it depends who you're subscribing to as to what you're going to be investing in. So I think there needs to be a more qualitative angle to this. And interestingly, if you then looked at the earnings estimates, there was a 3% variance. So it shows you that there's still a wide opportunity here for a more nuanced approach to ESG investing that actually does actively investigate what are the issues here to differentiate the good, the bad, and the ugly.
Just to break in there, as an investor, then how do you analyze these benchmarks that companies set forward, or the statistics that an ESG service kind of puts out about a company?
Yeah, that's very difficult to do, that, isn't it? Is the answer, because there isn't a standardized one. I'll give you an example from where we invest. We don't use a benchmark. We're an absolute return fund, so we're active, so we're uncorrelated. And if we were correlated, it would be about 50%. In the actual Refinitiv Sustainability Index, there are 9 companies that are actually in there. So it's not possible to actually construct a portfolio that's diversified enough, to be risk-adjusted returns that would satisfy any fund manager with just 9 holdings. You also find that there's a lot of passive money, passive investor money going into these sorts of things. And are they really actually changing the world? Are they making the world become more sustainable? If you're already investing in companies, they've actually got a rating anyway. Surely we want to invest, we want to be active in actually changing companies' ways to become more sustainable, and therefore they're not going to have an actual rating as such or be an index. So I would actually say I ignore them. There's no benefit to them at all at the moment. That will change over time, of course.
Yeah, I totally agree with that. And I think, well, per my previous comments around the wide variance in scoring, I don't think, well, I'm yet to find an appropriate benchmark per se with regards to ESG scoring. I think, per Nick's comments, where we think the conversation is going slowly, but it is going there, is this more nuanced approach to ESG and people getting inside the tent to engage with companies more readily and encourage change of behaviours that way. I mean, the divestment, for example, of fossil fuel assets does not solve anything. It doesn't. The asset doesn't go away. And indeed, if we shift the ownership of these assets from public markets where they sit today to invariably private equity or state-owned entities who either don't A, have a responsibility to shareholders, or B, have any cares about what the impact is on local communities and indeed the world's carbon footprint, then the problem's not being solved. So the inverse, of course, is to get inside the tent and engage with companies to encourage them to change. And I think that, well, in the Tribeca view, is the way the conversation needs to shift.
I would agree with that. It's a two-way approach, and you have to work with companies to get that sustainability pathway actually happening. And I think companies need to adopt and understand that they need to also be engaged in that process. It's not just a case of outsourcing it to get a rating score.
That's right.
So, I mean, we can look at things like, the environmental, the social, the governance. Are there kind of is there a priority that investors take when it comes to looking at companies? What are some of the key things that you look for? And we had a question come in from the audience following on from that, really looking at, what do you think the primary focus should be for the executive and the board of the company to be focusing on to get the attention of investors on the ESG front?
Well, I think I've been pretty vocal in saying it needs to be pretty broad based. I mean, I think the reality is at the moment that there still remains a very heavy focus on obviously environmental factors. And carbon is a case in point of scope 1, 2, or even 3 emissions, and how companies are being pressured to reduce that, which is obviously a good outcome. There's nothing wrong with that. But again, as I touched on earlier, some of the biggest issues that we face in the mining sector is the social factors of the impact on the local communities. And you can't ignore that. I mean, at the end of the day, it doesn't matter how good your ore body is. If you don't have a social license to operate, you're not getting anything out of the ground. So that is going to be an ongoing challenge. And indeed, as the world, to your opening comments, Amy, the world needs an awful lot of any number of various commodities in order to decarbonise. And yet we're facing, the mining industry more broadly is facing increasing difficulties and challenges with regards to resource nationalisation, permitting challenges, and all of this is fine in terms of a watching over and a close eye that needs to be placed upon these mining companies given their social impact. But it is going to be more and more challenging, frankly, as companies face more and more issues with regards to a not in my backyard approach to mining development, which is not going to go away easily. So, and Andrew can probably answer this better than me, but your social footprint is becoming more and more important.
Look, absolutely. I think you're spot on. It's got to be a broad-based approach. We obviously as a business started with carbon. I think that's where you naturally sort of start. And we're pleased to say now we're one of only 3 ASX listed resource companies that is carbon neutral today. But as we've evolved, as we've gone through, implementing various strategies and things, we've started to put a lot more emphasis on the social side and certainly the governance. And I think, I'm actually a former fund manager myself, and I must admit, when we were looking at companies, we would look very strongly at the governance side of things. And I think, with good governance, even within smaller companies, breeds a lot of good questions and a lot of good thinking around how do we evolve these businesses, how do we make them more sustainable, how do we work with the community, how do we get this developed, and so we've sort of started with that. We've got I mentioned before, we've got 66% of our board is independent, and that's been deliberate, and we'll work on improving that over time. And we've got strong female representation, but if you look at the social side of things, particularly around our Mount Chalmers site, there are and this is quite a theme through Queensland. There are challenges with working in unison with local landowners and whatnot. So we sort of identify that early. We're quite lucky that our Mount Chalmers site is already a historic mine, so it's already a disturbed site, and that will obviously help. And a lot of the local community worked in that mine, dating back many decades, so they have already a good feeling for the process and the employment prospects and those sort of things. But we've been engaging a lot of the local community as caretakers for the mine, they're doing a lot of remediation works. We've got excavator drivers that are we're getting locally, and certainly we're procuring a lot of our staff locally. So that's had a really positive impact on how we're going so far, but we know we need to do more. So we'll continue that, and particularly I suppose being a business where we do see that this particular mine will move back towards production, as Todd mentioned, that's particularly important focus for us, is to make sure that the community benefits just as much as our shareholders. So there's that sort of win-win mentality, certainly, and thinking within our business to try and make sure that they come along for the ride and are rewarded in all sorts of ways as this transitions to production.
So we've had a few questions come in from the audience, which I think are quite relevant to this kind of investment discussion. So one of them is asking, are fund managers willing to accept lower returns as companies pursue their ESG requirements? And I guess to add on to that, do ESG requirements necessarily mean lower returns? Todd, if you want to maybe.
That's an interesting comment. The reality of it is that actual ESG funds, there isn't lower returns. And that's been raised a lot from a European perspective. Most of the actual ESG funds provided just as good returns as non-ESG funds. So that's yeah, an interesting point to make. And I think that most ESG fund managers are willing to accept lower returns if, you know, for a better world, for a better climate, you know. So the answer is yes to both of those from a European perspective.
Yeah, I think you're right. I'd agree with that. Mind you, I'd also say to your second question, Amy, I don't think you need to accept lower returns. I don't think it's required. Indeed, and as Nick says, you know, the data points out that the top quintile of so-called ESG performers are outperforming in their actual share price performance. So now, whether that's a flow of money effect, I don't know. But, you know, obviously you need to take some of that into consideration. But the reality is that I don't think you need to be willing to accept lower returns. I think indeed, you know, your better performing ESG companies should attract more investors just purely through their pursuit of better practices.
Yeah, that's right. I would think that companies that are, you know, looking at these strategies and actually implementing them now, you know, I'd like to think they're more forward thinking and are, you know, really thinking about, you know, the impact of their activities on, you know, on a wider group, not just you know, their employees and shareholders. So, you know, I think that's you know, very positive. And I think you're right. There are certain you know, groups out there that are talking about, you know, that are even getting better returns, outsized returns, investing in these sort of companies. So I think, you know, just the fact that they're thinking differently, I think is really positive. And let's be honest, mining particularly is a, you know, has a very certain quite set practices. And I think, you know, those who are starting to challenge a lot of those practices and think differently, you know, I think will be rewarded, and certainly I think the funds will be rewarded as time goes on. And I think the other side of this too is the fact that what is the cost of not doing this? And so there's the return side of things, but also there's the cost. And, you know, I think those that don't sort of get on board, you know, we'll start to see increased costs as time goes on, whether it's, you know, tariff or non-tariff barriers, exporting your minerals into other countries. Obviously, a large percentage of Australia's minerals are exported overseas, and certainly we're seeing some of that in Europe, of all places at the moment. You know, things like, you know, I'm hearing that the JORC code is looking to implement, and if not, why not, sort of clause in their upcoming updates about, you know, what are companies doing around this ESG, and how are they managing a number of, you know, how are they managing their business to you know, to put them in a you know, to implement better practices. So there'll be a regulatory cost, I would think, as time goes on. And the other thing that I think that a lot of people aren't thinking about is, as we get closer to those key milestones of 2030 and 2050, where a lot of these businesses are committing to, you know, to actually decarbonize their businesses by, you know, I would think there'll be an absolute rush for all sorts of technologies. You know, there are a lot of businesses who leave things at the last minute, believe it or not. So I would think costs potentially rise, you know, as we get in, and certainly particularly on the offset side, we've seen over 100% increase in carbon offsets over the last 12 months. So I think it's also, we need to balance the reward with what's the cost of not doing it. So and that'll obviously have an impact, you know, probably later on, but certainly on investment returns over a longer period.
So we have another question asking, from an investment perspective, what credit do you place on Scope 3 emissions reduction? And the audience member gives an example of a developing vanadium deposit, and it's used in steel and energy storage, both reduce emissions, and therefore their overall emissions are actually negative if you include scopes 1, 2, and 3. What does this mean to you?
Yeah, I'll jump in. Well, yeah, look, Scope 3 has obviously been a difficult one for many, given your inability to some degree control, obviously, your customers' consumption of your product. Now, having said that, I guess one person's Scope 3 is another person's Scope 1 by definition. So that, in effect, if everyone is making the significant steps to address their scope 1 and or 2 emissions, they are going to be reducing someone else's scope 3. So that they are interconnected. But obviously scope 3 has been a difficult one for many companies to, I guess, incorporate into their broader carbon emissions reductions. That said, it's more relevant to some industries than others. Obviously, the coal mining industry or the oil and gas industry is far more exposed to something like a scope 3 emission target or reduction target. Now, going forward, I think if we all address scope 1 and 2 directly, scope 3 comes down, as I say, inherently. But I think it is increasingly becoming a focus, yes.
And I might just add to that, Todd, and say that, it's obviously one of the hardest sort of elements to tackle. And I think, you've got to start somewhere. So you've got to start, I think, on your own business and what you're doing first before you sort of move it further abroad. But, just to give a practical example of what we're doing, we've actually just recently purchased a drill rig. We knew looking into the new year that, that drilling would be our biggest expense or biggest cost for the year, and a lot of companies, drilling companies, weren't prepared to use a renewable fuel in their drill rigs and things and their equipment, because it's so we've actually gone to the effort of actually purchasing a rig. We've just had an RC rig arrive on site and 4 trucks, and so we're probably going above and beyond. But I think these are some of the measures that companies can take if they're not getting the sort of response out of their suppliers that they need. But I do think I'd agree with Todd. It's going to take a little bit longer for those sort of emissions to be tackled. It's you've really got to start with, I think, your own business in your own backyard before sort of moving on.
Okay. And another question has come in asking, every renewable energy technology today requires minerals. What type of messaging responsibility around this do you believe sits with funds maximizing ESG, not only to clients, but to the market?
Well, yeah, that's something that we scream from the rooftops, but that's because we're investors in resources companies. So it's an easy one for me to talk about. I do think, that the point is a very relevant one, not least insofar as the point I made earlier about the divestment of assets versus, I guess, getting inside the tent and managing those assets more readily with management teams. I think it's a challenge insofar. I mean, you look at the Biden administration in the US, who've come out and listed a list of so-called critical minerals as long as your arm with regards to their pursuit of net zero by 2050, which is well and good, except that, then in the same breath, they make it very difficult for the world to develop new mines in the US, which is kind of ironic, or indeed their, need to consume more and more oil in their gas guzzlers, so they restrict drilling for oil and gas in the US, and yet reach out to Saudi and say, "Can you please pump more oil?" So I say this is slightly tangential but connected insofar as it's actually not just ESG investors, but it's also governments that need to be cognizant of the fact that we need more and more of these commodities, and having a manageable framework in which companies can develop their assets without risk of nationalisation or a shift of the goalposts is also very important.
Do you find that this kind of nationalisation has become a bigger issue as we go on, especially with the supply chain issues and stuff?
Oh, look, absolutely. It's an issue that's raised its head increasingly so, particularly in the last couple of years, I think, in the COVID environment, where governments have become very internally focused, and the political landscape has become very populist in its nature and its discourse. And I mean, you only need to look so far as, and Andrew would well know this given he's a copper hopeful, 40% of the world's copper comes out of Chile and Peru, and we've got massive change going on in the political spectrum over there. I mean, obviously, Peru have just elected a fairly hard left-leaning candidate for the presidency. Now, the reality, the rubber hitting the road will be something different, I expect, compared to some of the populist policies that were proposed in that election battle. But the Chilean country is now going through a complete rewrite of their constitution with the prospect of obviously increased taxes and royalties and the ability to nationalise assets. So, Chile sits on one of the world's greatest resources of copper in the ground, and yet if you are a company looking to invest significant amounts of capital to extract that copper, you're going to have second thoughts if you feel that there is a risk of A, your returns, but also B, your ability to hang on to those assets.
I agree with that. I mean, we as a fund, we tend to favour things that are actually in Australia. Although there's not a lot of choice, and we wish there was a lot more, there has certainly been a lot more investment into exploration. I'm sure there'll be a greater amount of investment. We find as a European fund that money coming into our fund inflows, we've got this unique selling proposition that we are a team base in Western Australia in Perth. And if anything, we want to look to invest in things in our own backyard, which it's great opportunities for Australia, I think. And I think, Todd, you'll probably find that over East as well. It's a fantastic place to be and a good time as well, without doubt.
That kind of leads me well into my next question, which was, we had audience members in advance asking about specific commodities such as uranium or coal, as well as geographies that ESG, that investors would be willing to look at. So how do you break down your focus with these regards, whether it's commodity specific or geographically focused?
Well, we take a top-down approach. We're a natural resources fund, but we split it across agriculture as well, the metals and mining and energy. But in the energy space, it's renewables. I have to be honest, with the moment, because we're an active fund and we're not a benchmark hugger, we are generally 30% in battery metal space or base metals. So we've got about 10% in copper at the moment, and we'd like a lot more. So very keen on that space. We focus on Australian companies first and foremost, and that could be listed on any recognised investment exchange around the world. But generally, we'll look at ones that are ASX listed first and foremost, and that have projects within Australia from a geographical point of view. Then once we've sort of run out of stocks to select, because we'll typically hold between 80 and 100 investments. We'll then look to ASX companies that have got exposure to mine sites, either in exploration, development, or production across the world. We will look to Latin America. We'll look to the US, Canada, and Africa. But the preference is really to go for Australia at the end of the day, for both an ESG perspective and from a mining perspective.
Yeah, with regards to the way we look at things, we are a global fund, a global resources fund, but we do have obviously a strong Australian flavour. We do have a large number of the team based here in Australia, and I think as we've just talked about, the safety, for want of a better description, of investing in Australia is clearly had more value placed upon it in recent times. With regards to separate commodities, we do have a significant component of our portfolio invest in both base and battery metal space, but we are also a very large investor in uranium. We've been quite a vocal supporter of the nuclear power industry and its need, we think, to support the whole decarbonisation transition that we are going to make, and that is a function of the fact that it's obviously a low or zero carbon footprint baseload power provider that can be obviously of great support to the so-called, by some, weather-related energy sources of solar, wind, etc. Now, that obviously leads us to investing in a number of uranium companies, and indeed we do have a separate nuclear energy opportunities fund. But obviously the number of uranium producers you can count on. Well, you don't need to take your shoes off, put it that way. So it's obviously a very short list. Now, there's no shortage of uranium explorers anywhere in the world, and uranium captures its degree of headlines. But it's hard to believe that we're now 11 years since Fukushima and the very negative headlines that brought to the nuclear power industry. but we're now finally starting to see the conversation shift, and we think that bodes very well for uranium investing, not least because the demand is returning quite quickly, and yet supply remains incredibly constrained.
Looking at Australia specifically, we had a question asking if you think the Australian mining industry is likely to adopt green revenue reporting, such as within the EU taxonomy.
I think eventually, yes, be the answer. ESG principally came from Europe, from SFDR. And I think that will eventually get out here. You've got to bear in mind that in Australia, there is no legislation that says that you have to adopt a sustainable pathway at the moment. So there isn't any rules in place. It's something that Australians are embracing and are catching up very quickly. So yeah, I think anything, generally speaking, that starts in Europe does make its way out here eventually. Yeah.
And there has actually been a follow-up asking, are there key policy settings that you'd like to see from the government in this regards?
I might jump in there and say, look, I think it really needs to, we've got to lead this from the top, and I for one would like to see some more movement in this area. Obviously, leading into COP26, we saw some last minute sort of policies adopted and whatnot. I must admit that I'm heartened by the fact that we're certainly seeing a lot of investment from government, a lot of also by state government and even local government, around Queensland in these sort of areas, and we're seeing a lot of these new renewable energy zones, which are really starting to fast track some of this investment into the space. But I think ultimately to make this transition, we need some real leadership from the top, and I think obviously we've talked about carbon taxes and things in the past. I don't think obviously that didn't quite get there for various reasons, but I think we need to see some changes to start to implement this and to meet some of our commitments on a world stage. So.
Just to let our audience know that we are kind of close to wrapping this up. So if there are any other questions for our panelists, definitely feel free to type them into the Q&A box. My kind of question was really, what is the way forward for miners and investors to kind of bring these ESG discussions to the ground and to get things moving? What are some of the key things that we need to see addressed, and the key kind of policies put in place? All of it. What do you need from each of your?
Sure. Well, look, I might start on the mining side. I think from a business perspective, you need to start by understanding, what you're doing now. So you need to understand your carbon footprint. You need to understand where a lot of your carbon emissions are coming from. You need to talk with your local constituents. You need to understand, get the feedback from the community and whatnot about your operations in any jurisdictions. And you need to take those on board and engage those sort of third parties and make them part of the process. So with QMines, we started with a carbon audit, and that's how we sort of started to work out, what were the best strategies that we could implement to transition our business. And so we actually used the Australian government has they call it the Climate Active certification. And there's about 350 businesses at the moment that are, certified carbon neutral under Climate Active, and that's the Australian government stamp for carbon neutrality. So we started there, and that's an independent process that allowed us to do a carbon audit and really understand, what parts of our business were emitting the most carbon and how do we go about, trying to abate those emissions. So I think that's the first step, and you can do that with your, all parts of the ESG, ES and G. Governance is obviously another very important part, and I think it doesn't matter whether you're, your BHP right down to, the small cap companies. I think, you can apply, good governance practices. You can, build in, good independent thinking and oversight into the way you manage your businesses. And I think over time that you'll actually be rewarded, because you'll find more, as you improve those governance practices, more institutional capital will start looking at you more closely. So I think from the mining or the company perspective, I think you've got to start by really understanding where you are now, what your emissions are, what are your relationships with the local community like, and how can you improve them? How can you make them involved in the process, and at all times try and be best in class in terms of governance.
I would agree with that. I think just to add to that, it would be very nice to see governments over here, whether that's local or federal, actually provide some sort of incentive for companies, and that can be through helping with cost of implementing a roadmap. It's not that expensive to adopt these policies, but I think there is a need for a bit of more education and perhaps some incentive for companies to do this. Because we're talking predominantly about natural resources and listed companies. Well, we can extend this throughout to private companies as well. So I think that there could be a lot more done by government.
I think that's been a lot of the problems we face today with regards to the reputation of the mining industry. Unfortunately, it's a bit like the weakest link, isn't it? Where one bad seed, one bad apple ruins the barrel. Where, with regards to the performance of one, it gets all the headline attention and taints the entire industry. So, to some degree, I also like to see a bigger step made by industry bodies as well. I think industry bodies are the broader mouthpiece for the industry, and where they have been perhaps slow to move in the past, I think they should be looked upon to make some quantum leaps forward with regards to the way they encourage their members to behave. Obviously, coming back to Andrew's point, and I think QMines are obviously doing a great job of doing the right things at the start. It's clearly more difficult to change your behaviours once they're entrenched, rather than establishing the right behaviours from the get-go. And I think that's, if anything, I would say a great lesson for the junior end of the mining spectrum, is to, if you get all your practices and your policies and the way you measure your environmental footprint, the way you measure your social impact, and indeed there are obviously more and more, technology platforms as well that make that more easy, that are popping up on a day-to-day basis. But if you entrench those behaviours early, it clearly makes it far easier to encourage those to remain as you grow and mature as a company.
Do you think there's more kind of communication and PR that needs to be done just about the mining industry as a whole, and kind of why it's needed for a decarbonized future?
Well, I guess there's certainly, it's happening more and more, but I think more needs to happen, because there is still a perception there from some that all mining is bad, despite the fact that they use their mobile phones and don't quite understand where the component parts come from, or indeed the rest of their the roof over their head. But there is certainly a perception issue with regards to, I think, some aspects of mining, or indeed the need for more commodities. Now, obviously, you see a little bit more in the way of TV ads. BHP obviously talking up their production of copper, despite the fact that they're still really largely an iron ore company, but that's not split hairs. There is them talking about the need for more copper and where copper goes into, but I still think there's a knowledge gap with regards to the greater population as to what we will need with regards to more commodities, and how much lithium, copper, nickel, cobalt, you name it, really will be required in an ongoing fashion. What we are seeing, interestingly, is more moves from governments to move away from some geopolitical risks with regard to their supply. And of course, this comes back to and plays nicely into the hands of what we were talking about earlier with regards to, for example, investing in an Australian producer. We've seen quite a number of policies brought in place, whether it's in North America or the EU, with regards to the sourcing of some of the key decarbonisation enabling commodities, and that will continue to occur. And that's not least of which, commodities like whether it's cobalt or rare earths or lithium, which are in the current balance of power very much reliant on Chinese supply, and clearly in an increasingly fraught relationship that we and others have with the Chinese, it's clearly of increasing import that we diversify our source of that supply as well.
And so, that's all of the questions that I had today. I think we can probably take one more from the audience before we wrap it up. So we had a question that asked, for tier 2 miners seeking investment, how progressed do you expect their pathway to be a viable investment? Is there a way to quantify that?
I think the simple answer is no. You can't quantify that. It's horses for courses. And as I think I said earlier, when you're looking at a company, you want to be active in actually making the company become sustainable. So, and I find many companies that I'll meet, they'll want to put off before they actually engage in doing an ESG roadmap, because they want to make things look a little bit better. And the whole point is there's not, do it now. There's no set time. The time is right now to do it and to embrace ESG and have a roadmap to make those changes. So do it as soon as you can.
Yeah, look, I'd agree with that. I think, a lot of companies are still in that, strategy sort of phase. They're not really in the implementation phase. And I think, we've all got to think about what is the cost if we don't do it. And I think that's sort of one of the last sort of thoughts I'd like to leave out there, is that, this will become more difficult as we get closer to those key sort of, 2030 and 2050, bench, milestones. And I think, if there'll be a clamour for, for technologies, for carbon offsets and whatnot, and what's the cost of not doing it, and certainly, obviously, a lot of companies that don't do it will start to miss out on the sort of investment that Nick and Todd are sort of talking about today. So I think it's important that as an industry we think about what's the cost, not just what's the benefits. So because it will come, and I think it'll get it'll create a lot more issues for you further down the line. So.
Great. Well, I think that's a really good place for us to end. There were, a lot of really insightful points made today on ESG and the mining industry and investment, and kind of how we can move forward with this. So I'd like to thank all of our panelists for joining us today, and thank you to the audience for taking part and asking your questions. We will have this video ready to view within the next few days if anyone wants to have another watch. But we look forward to seeing you all soon. Hopefully, with borders opening up, we'll all be at some live events very soon. So thanks, everyone.
Thanks, guys.
Thank you.
Thank you.